Picture this. A lone wolf investor who once made billions by going against the tide is at it again. But this time he's not just betting against a housing bubble. He's betting against the very pillars of Wall Street, S&P 500 and NASDAQ. Now, why would he do that? Could he be onto something that the rest of the world is blissfully ignoring? Intrigued? Let's dive right in. The legend of Michael Burry. Before we dive into the nitty-gritty, let's talk about the man himself, Michael Burry. You've seen the movie, you've read the headlines, but who is Michael Burry really? Born in 1971, Burry was diagnosed with Asperger's syndrome at an early age. This neurodivergent condition gave him a unique perspective on the world, one that he would later apply to financial markets. He's not just a Wall Street guru. He's a medical doctor who left a promising career in neurology to follow his passion for investing. Burry wasn't always in the limelight. He started as a neurology resident but soon realized that his passion lay in the financial markets. He quit his residency, started a blog about value investing, and eventually founded Scion Asset Management. He first gained fame for his audacious bet against the housing market back in 2008, a move that earned him a fortune and a place in financial history. His unique approach to investing caught the eye of many, including the author Michael Lewis, who decided to chronicle his journey in the best-selling book, The Big Short. The Big Short 2.0? Fast forward to 2023, and Burry is back in the headlines. But this time, it's not subprime mortgages, it's the entire U.S. stock market. According to SEC filings, his fund, Scion Asset Management, has taken a bearish position against the S&P 500 and NASDAQ 100. Specifically, he's bought $866 million in put options against a fund that tracks the S&P 500 and $739 million against a fund that tracks the NASDAQ 100. That's a whopping $1.6 billion bet that these markets are going to crash. Now, you might be wondering, what's the rationale behind such a massive bet? Well, Burry has been quite vocal about his concerns. He believes we're in the greatest speculative bubble of all time. And he's not just talking about a few overvalued stocks. He's talking about the entire market. Burry has also been critical of the passive investing trend, where investors pour money into index funds and ETFs. He argues that this flood of capital is inflating stock prices to dangerous levels. In his words, all theaters are overcrowded, and the only way anyone can get out is by trampling each other. Interestingly, Burry hasn't been consistently bearish. Earlier this year, he tweeted sell, only to backtrack a few months later, admitting he was wrong. This flip-flopping adds another layer of complexity to his current position. Is he genuinely bearish, or is this another momentary lapse in judgment? While Burry's bearish bets have grabbed headlines, it's worth noting that about 6% of his portfolio is long. He's increased his exposure to the travel and healthcare industries, buying shares in companies like Expedia and CVS. So, it's not all doom and gloom in the world of Michael Burry. The stakes are incredibly high, not just for Burry but for anyone invested in the stock market. If he's right, we could be looking at a market downturn that makes 2008 look like a minor hiccup. But if he's wrong, it's not just a financial loss, it's a blow to his reputation as a market savant. That's the million-dollar question, isn't it? Or should I say the $1.6 billion question? Will Michael Burry prove to be the oracle of Wall Street once again, or will this bet be his undoing? Having said that, let's talk about the elephant in the room, the current state of the market. With the S&P 500 and NASDAQ hitting record highs, you might wonder why anyone would bet against them. But Burry sees things differently. He's concerned about the factors that could turn the market on its head, the factors that most of us don't even recognize. The market conditions for 2023 are anything but straightforward. With inflation rates hovering above comfort levels at 3%, central banks are under immense pressure to tighten monetary policies. This is particularly true for the Federal Reserve in the U.S., where a mild recession is expected by the end of the year. The European Central Bank is also grappling with inflation, and there's a likelihood of rate hikes to 4%. Nevertheless, inflation isn't just a number. It's a ripple effect that touches everything from consumer spending to business investments. High inflation rates mean that your dollar today will be worth less tomorrow. This creates a sense of urgency among consumers to spend now rather than later, which can drive up demand and prices even further. Equity markets are also in a precarious position. In the U.S., the stock market is expected to face a challenging macro backdrop in the latter half of 2023. The main driver of stock performance, multiple expansion, is expected to decelerate, leading to unattractive risk-reward scenarios for equities. To add fuel to the fire, there is the chaotic geopolitical landscape. The aftermath of Russia's invasion of Ukraine is still being felt, and global policy rates have risen by almost 400 basis points since 2022. This has had a significant impact on interest-sensitive spending in factories. While China, a significant player in the global economy, is also going through a period of uncertainty, Europe is not faring much better either. High energy prices have weighed down the Western European economy, and although there was some relief in the first quarter of 2023, the economic growth forecast for the rest of the year is between 1.5% to 2%. These events have the potential to disrupt global markets, and Burry might be factoring these into his calculations. After all, he's not one to ignore the bigger picture, the expert opinions. While Burry's moves have been controversial, he's not alone in his skepticism. Experts like Bruce Kasman, chief global economist at JP Morgan, are not optimistic either about inflation rates coming down to central bank comfort zones anytime soon. Similarly, Dubravko Lakos-Bujas, global head of equity macro strategy at JP Morgan, sees a challenging landscape for stocks in the latter half of 2023. However, the majority remain bullish, making Burry's position all the more audacious. The debate rages on in financial forums, with armchair analysts dissecting his every move. But love him or hate him, you can't ignore him. One intriguing aspect, however, in all this, is Burry's recent silence on social media. Known for his candid tweets, he's been unusually quiet, leading to speculation about his next moves. Is he planning another big bet, or is he simply lying low, waiting for the market to prove him right or wrong? Let's get a bit technical. Burry's bearish bets are primarily through put options, which give him the right but not the obligation to sell the underlying assets at a predetermined price. It's a high-risk, high-reward strategy that could either make him a fortune or cost him dearly. It's worth noting here that Burry's current bet has historical precedence. George Soros famously broke the Bank of England in 1992 by shorting the British pound. While the scale and context are different, the audacity is similar. It's a reminder that sometimes the biggest risks yield the biggest rewards. So where does all this leave us? At the edge of our seats, that's where. Michael Burry's latest bet is more than just a financial gamble. It's a litmus test for the market, a challenge to conventional wisdom, and a story that could define this decade in finance. This brings us to the end of this video. If you liked it, please consider subscribing and sharing so we can keep bringing more content like this. And don't forget, we do a weekly giveaway of $200 worth of Bitcoin. Just like and subscribe and comment. See you next time.